SoFi's stock price is down more than 10% today, January 27, 2025. And a lot of SoFi stock investors are asking, what's going on with SoFi stock? Why is the price down? Is there a reason for this? And the answer is, well, the company announced quarterly earnings results. And on the day of quarterly earnings announcements, the stock price is more volatile than usual. It goes up or down by a larger percentage than is usual. So in this video, I wanted to go through some of the details that were announced in that quarterly earnings release that could have implications and that SoFi investors should know about.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So a couple of things that were encouraging for SoFi stock investors is that the student loan segment is finally coming back to life. After years of struggling because of government changes and government policy regarding student loans that hurt SoFi, it looks like the business is back. In its latest quarter, students' loans saw its best quarter of originations since the end of 2021, reaching $1.3 billion, a 71% year-over-year increase. This is great news for SoFi stock investors for a couple of reasons. Number one, it boosts the company's revenue. Number two, the student loan segment is less risky than its personal loan segment, which has been growing much faster than the rest of the business, which makes SoFi riskier than usual. And all else being equal, investors prefer lower risk. And so this growth in the student loan segment helps its revenue, but it also lowers its risk because the percentage of loans growth in the most recent quarter shifted more towards student loans. And that's great news. Investors of SoFi stock will want to see more of that, especially from this next segment, home loans. Saw its best quarter of originations also since 2021 across all products, including purchase, refinancing, and home equity loans, with originations of $577 million, and that was an 87% increase. And that was great news. The home loan segment is even less risky than the student loan segment because home loans come with collateral. Collateral is key because if your borrower defaults, then you have collateral that you can go and take to make up for the loss in payment. And so that lowers the risk from the lender perspective. If you lend out $1 million for a home loan and that buyer puts down 20%, you have $200,000 in equity in that home. And so if the buyer defaults, then you can go back and take the home, sell the home, and recoup your investment. That's why home loans are less risky than student loans, which are less risky than personal loans, the most risky loans, because personal loans have almost zero collateral all the time. If your borrower defaults, you can't typically recoup anything. You can call and you can try and convince that borrower to pay you back something, but you don't really have any leverage. You can't take back any assets when you're lending in a personal loan versus a home loan. So it's great to see that SoFi's growth in these two segments were much faster than the personal loan segment, which de-risks the business to some degree. Speaking of risk, credit performance. This is where the majority of risk is in SoFi stock, is in credit performance, because it has such a large percentage of its business tied up in loans and lending. The performance of those loans has a great deal to do with the success of the business. Now, in the most recent update, the balance sheet 90-day personal loan delinquency rate decreased to 55 basis points from 57 basis points in the prior quarter, while the annualized charge-off rate decreased to 3.37% from 3.52% in the prior quarter. That's big because that means that the loans that SoFi is making are defaulting at a lower percentage. That means people are making their payments. That's good news because the lender doesn't lose money in that situation. For 2024, there was a big risk that the US economy might tip into a recession because of higher interest rates, because of credit balances on personal balance sheets were increasing. The economy wasn't growing as quickly. People had, for the most part, spent all of the money they received from the government in stimulus checks and etc., right, that they used to improve their balance sheets. That has mostly been undone, right? People have spent a lot of money since the economic reopening, and all of that spending has resulted in lower balances in their bank accounts. And so people's balance sheets are now in a more precarious position. On top of all that, people are spending more on everyday living essentials, things like food and rent, healthcare, things that is not discretionary. People, you don't choose to spend money on food. You have to spend money on food. You don't choose to spend money on rent. You have to spend money on rent. And those mandatory expenses on people's balance sheets have increased substantially in the last 5 years. People are spending more money on food, on transportation, on rent than they did in 2019 because of inflation. And so that makes it more likely that in the event of an economic slowdown, that people are unable to pay back some of their loans. People are unable to pay back some of their personal loans. And if you're thinking about an average person in the economy, in the US economy, in aggregate, if we look at things, and their income decreases to the point where they can't meet all of their obligations and they have to choose which obligations to meet because they can't pay everything, right? And so you have to make those tough choices. If I can't pay all my bills, which one of my bills do I not pay? And of those choices, the personal loan is one of the highest, one of the first things that people will stop paying. And the reason is because you're not going to stop paying your car payment. If you stop paying your car payment, the lender can come and repossess your car. And now you don't have a way to get to work. So you're going to protect that asset, right? And then your home loan, you're not going to stop paying that because if you miss your home loan payments, the lender can come and repossess your house and foreclose on your house and you're left without a home. So those are things that you're going to pay until you absolutely cannot pay anymore. And so what's left, one of the things that's left is personal loans, where if you don't pay, the consequences are less severe than if you don't pay your car loans and if you don't pay your home loans. And so that's why this credit performance improving is great news for SoFi. It's also great news that the home loans and student loans are growing faster. And so I already talked about why these loans perform better than personal loans. And so overall, SoFi is a less risky business as a result of the developments in the latest quarter. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.